The up part about investing is that even though it is a key to financial freedom, investing is a world full of gatekeepers. See, it gets me so mad, it has me cussing in the first sentence of my video. Think about it. We don't learn how to invest in schools. Investing once required having a high minimum investment to get started. And even once we get into adulthood and we're told to invest for retirement, no one actually makes sure we understand what we're doing, why we're doing it, and how to make sure that we are properly prepared for that retirement. So without proper guidance and education, and because there are so many gates to get through, most people never get around to investing. And unfortunately, if you never invest your money, it's going to be nearly impossible to truly reach financial security. And it's definitely going to be impossible to reach financial freedom. But here's the good news. There are now so many resources, so many tools, and so many people like me who can help you bust those gates wide open and start investing to build wealth. In this video, I am going to cover what is investing, what is an asset, an introduction to financial markets, and the basics of stocks and bonds. Now, I want you to know that it is okay if you struggle at first. Maybe you've tried to learn this before and it just didn't make sense to you, or maybe this is your first time and you watched through the end of the video and at the end of it you're still kind of like, kind of makes sense, not fully there yet. Like I said, historically there have been many gatekeepers to this information, and on top of that, systemically, you are at a disadvantage if you are part of a marginalized group. If you didn't come from money and you were never exposed to finance or investing, whether that's from your parents or from schools, then you are at a disadvantage. You don't have that privilege to just walk right in and start building wealth. But don't worry, you'll be able to learn and catch up. Now, just to be clear, in this video, I am not talking about the logistics of how to get started with investing, but once you get through this video, you can watch this one up here for 3 ways on how to start investing with just $300. Now, before you go over there, I highly recommend you watch this one first, especially if you've ever struggled to understand investing. For those new here, hello and welcome. My name is Lissa and I'm an accredited financial counselor. Now, I personally did not learn much about investing until my 30s, but now I'm a personal finance expert who just wants to see more women of color winning in life. To be clear, anyone can be here, anyone can watch this, but my goal is to make the world of wealth and finance more inclusive for people who have been historically marginalized. So what exactly is investing? What you need to know first and foremost is that the whole point of investing is this: to make more money. Specifically, investing is using your money to make more money. Now, at your job, you use your time and your energy to make money. With investing, you are using your money to make money, which simply means you have to have money to get started. Now, one of the biggest reasons to invest, aka using your money to make more money, is that when your money is not invested, you're actually losing value due to inflation. Inflation is a phenomenon that occurs in our economy that essentially causes your money to lose purchasing power over time. Now, we've all experienced this. Even though that dollar amount in your bank account stays the same, and even though the cash in your wallet stays the same, when items and services get more expensive, your dollars just don't go as far. $50 at the grocery store used to get you a whole cart full of items. Now, maybe you get half a basket, especially if you shop at Whole Foods or something like that. Investing is one way to preserve your purchasing power instead of losing it over time. Now, if investing was just about fighting inflation, which tends to be around 2 to 3% every year, then investing probably wouldn't be that exciting, because what's a couple percent of your money? But what's exciting is that you can actually make more than just 3% on your money. And that's pretty much why all wealthy people invest. Investing to make money requires so much less effort than it does to work 40 hours a week. Okay, Lisa, we get it. We're gonna invest because we can preserve our purchasing power by fighting inflation, and we can even make more money than just fighting inflation. But what is the catch? There's gotta be a catch, right? Well, technically, yes, there is a catch. The catch is really simple. It is this: there are no guarantees with investing. Once you put your money into an investment, yeah, you can technically lose the value of your investment. It depends on what you invest in and what your strategy is. What I would like for you to understand is that the likelihood that your investment goes to zero is very, very low if you incorporate strategies like diversifying your investments, meaning don't put all of your eggs in one basket. There are a lot of different investing strategies out there that fit for different people. A general rule of thumb is the more risk you take, the greater potential reward. And the lower risk you take, the less potential reward. The goal for you as an individual who wants to invest is figuring out which risk reward level is most comfortable for you, that aligns with your financial goals, that is still gonna beat out inflation. Now, there's actually a name for this possibility of losing the value of your investment. It's called market risk. So you are putting your money at risk when you invest it, aka you put it in the market. Whereas when you don't invest, you're not subjecting yourself to market risk. But here's the thing that wealthy people understand more than anyone else. Market risk is not the only type of risk out there for you and your money. Remember that inflation that we were just talking about? How you can lose purchasing power over time if your money is just sitting there? Well, that is also a risk. That is called inflation risk. So if you let your money just sit in a bank account or under your mattress or in your wallet, you are 100% subjecting yourself to inflation risk. There is a 100% chance you are going to lose your purchasing power because inflation is a phenomenon that does exist. So yes, there are risks that come with investing, but avoiding investing is arguably a bigger risk for your money. Now, up to this point in the video, you probably get the gist. If you want financial freedom and to actually build wealth, you have to invest your money. Now, yes, investing comes with risks, but so does not investing. So how do you invest? Well, the simple way of explaining how to invest is this: you purchase assets. What exactly is an asset? So there are many different types of assets. I can't name them all in this video, but some examples, so you know what I'm talking about, are real estate, gold, stocks, bonds, and so much more. Now, at the end of the day, the common theme for these assets are: 1, they are things you can purchase; 2, they are things that have value; and 3, they have the potential to create you more value. Now, real quick, on a philosophical level, think about this. What actually gives something value? What makes it an asset? Basically, things have value when other people want them, and things can increase in value when even more people want them. To hammer in this point, let's talk about the tale of two vending machines. Now, let's say both me and my sister Leah, yes, my name is Lissa and she goes by Leah, confusing. But let's say both me and my sister Leah each buy ourselves a vending machine. We both buy them for $2,000. Now for me, I bought this vending machine for $2,000 simply because I thought it would be cool to have one in my house to keep all of my snacks in. I don't make any money off of it because no one comes through to my house. I just have it for fun. Now, unfortunately, after a year, my vending machine breaks down, and unfortunately, the company who makes the parts for it has gone out of business. Now, my sister Leah, on the other hand, she also buys a vending machine. She also bought it for $2,000. She was able to place hers outside of her gym, where it makes her about $200 a month, which means $2,400 a year. So forgetting the fact that she has to stock it and pay for inventory, technically, she might be profitable. If she bought it for $2,000 and after a year, she's made $2,400 off of it. Then to take it a step further, after that year of owning it, someone just offered her $3,000 to buy the whole thing from her. Because all of a sudden, vending machines are hard to come by, they're hard to find, and that person really wants to start their own business. So not only did my sister Leah make money from her vending machine sales on a monthly basis, but she was able to sell it for more than she bought it for. Her investment of $2,000 appreciated to $3,000. So all of this to say is that we are talking about the same item here. One is an asset, the one that my sister has, because it has value and it has the potential to make more value. Whereas my vending machine is not an asset. It is a liability. It's literally trash because it doesn't work. It's just sitting at my house. No one wants to buy it and I can't even fix it, so I can't sell it for what I bought it for. So my sister's vending machine can be considered a real asset. Not only is it an asset, it's something that has value, that can be purchased, that can make her more value. It's called a real asset because it's something that's tangible. It's something physical that you can touch, see, and feel, and that you can put to use in the real world. It has utility. We have the easiest time understanding assets that have utility because we can kind of pinpoint what it is that thing is valuable for. For example, a house. You know that a house has utility. You know that it can be used for something. It can be used to put a roof over someone's head. It can be used as a business if you rent it out. But I want you to expand that idea for a second. There are assets that actually have no utility. There are things that have value simply for the fact that people want it and they're willing to pay for it, aka there is a market for it. Now, here is where most people get lost when we start talking about investing in the financial markets. So I want you to listen closely. I want you to take your understanding of real assets, which we just talked about, and sort of throw that out of the window. I know, my bad. It was a fun example, and that would be kind of cool to have a vending machine at my house. But what I wanted to point out was that what makes something an asset is that it has value. And something has value at the end of the day if other people think it has value and they're willing to pay for it. So when we're talking about investing in the financial markets, there's a whole bunch of buying and selling of assets. There are assets that have value that people want, so they buy them, they sell them, they make some money. But the assets in these financial markets are intangible. They are not things that you can see, feel, or touch, and they're typically not things that have utility in the real world. They exist for the purpose of making money. So these assets that exist in the financial world can be called a lot of things. Sometimes they're referred to as financial products, financial instruments, investment vehicles, securities, and the list goes on. You've probably heard of some of these assets, like maybe stocks or bonds and mutual funds, and I'll be willing to bet that there are other financial assets that you might have never heard of, or maybe you've heard of them, but you kind of ignore them when you do hear about them. For example, derivatives like futures or options. Now don't worry, that's more intermediate to advanced stuff related to investing. You do not need to know the intricacies of every type of financial asset in order to get started. I just want you to know that conceptually, these things exist. They have value, and their purpose in the world is to be bought and sold in order to make money. Now, for those of you who don't know me, maybe you're new to my channel, I need you to know that I never had a financial background. In fact, I avoided taking econ in school because not only did it sound hard and boring, but I thought I couldn't understand it, so I didn't want to mess up my straight A's. So instead of learning how to build wealth or learn anything about the financial markets or economics, I only learned how to earn money. That's why after college, I ended up becoming a worker bee. And instead of taking any time to learn about investing and using my money to make more money, I just learned how to exchange my time and my energy for money. Then on top of that, when I started to make more money in my career, I kind of invested in my 401k, but I didn't know shit. I didn't even know what the account meant. I knew that it was for retirement, but I didn't know that I was investing. I didn't know what I was invested in. None of it made sense to me. So all that to say is I did not understand investing for a really long time. So if you're having a hard time grasping this whole concept of financial markets and intangible assets as opposed to real assets, I want you to know it's okay. It might take a couple times. And in reality, you can start investing before you fully understand it and grasp it. Now I want to talk about stocks and bonds really quickly. One way that it has helped me to understand stocks and bonds, which we have already said are intangible assets, was to think of them like contracts or pieces of paper. They're basically a contract that promises you something in exchange. For example, stocks. Stocks represent a share in ownership of a company. So when you buy a stock, you own a share of that company. Now, can you show up to Apple's headquarters and have lunch there just because you own Apple stock? No, that's not how it works. So while no one actually sends you a signed piece of paper that says you own a piece of this company, that is what owning your stock represents. And it all goes back to what we said earlier. It has value. A stock has value. So here's a general overview of how stocks become a thing of value. When someone starts a company, new business, it usually starts as a private company. For example, let's say I have a company called Lissa Incorporated, and I am the only owner. This means I own 100% of the company. I could own, let's say, 1,000 shares of my company, and those are the only shares available. No one can buy those shares because it is a private company that I fully own. Now, after a couple of years, my company starts doing really well, and I decide I want to take the company public. This means I'm willing to sell off these shares of my company and make it a publicly owned company. The purpose of that is because I need some money. I want to take in some money that I can use to expand the business even more. I want to be able to hire more employees, open new locations, whatever it is, I need money and I want to become a public company. What I'm explaining is technically what happens conceptually in an IPO, an initial public offering. I am taking my company from being a private company into becoming a publicly owned company. And in order to do that, I have to let go of my ownership of those shares. Now look, for everyday investors like you and me, we're not usually involved in this process. What happens is that those investors, those institutional investors at the beginning of the IPO process, they are the people who buy shares of the company that's going public. And that's because they're the ones that have money. What those initial investors do is they buy those shares at the IPO, and then once the company goes public, and let's say Lissa Inc. is doing really, really well, there becomes more demand for wanting to own these shares. So those investors will start selling their shares to other people in what we call the secondary market. The secondary market is another intangible hypothetical thing, but that is where these stocks get bought and sold. They have to be bought and sold through registered brokers, which is why you're able to buy and sell shares if you open an account with a brokerage that allows you access to this secondary market. Now, this might not work for you, but for me, if I think of these shares like a contract or a piece of paper that states Lissa owns a piece of this company, then it gives me something visual to think about that makes it a little bit more easier to grasp, at least in my opinion. Because otherwise, what you own is this intangible asset that you can't see or feel and that has no utility in the real world. Now, let's talk about another intangible asset, which is a bond. So similar to a stock, a bond is also a financial asset. It's something that has value, it's something you can purchase, and it's something that has the ability to make you more money. Now, a stock represents your ownership share of a company. A bond is something completely different. It's a different kind of asset. So yes, it has value like a stock does. Yes, it can be bought and sold and traded like a stock, but it is based on something completely different. So let's talk about it conceptually. Let's say that a company or a government is looking to fund a project of theirs, so they need money. Now they want to borrow money from investors. Their whole goal is to borrow money, use it, and then they'll be able to make money back later and then pay back the people that they owe. How they do it is by issuing bonds. They sell bonds to investors. So this example, in my opinion, actually works a lot better when you're thinking about the piece of paper example. Bonds can be thought of as IOUs. If a company or government wants to borrow money from you, then you will give that company or government some money. In exchange, they'll hand you a bond, theoretically. If you are the holder of this bond, then they are promising to pay you back what you let them borrow in a certain amount of time. Let's say 10 years. So they're like, okay, give us some money now. We're gonna pay you back later in 10 years. And on top of that, as a thank you for letting us borrow your money, we're gonna pay you some interest every 6 months. We're gonna give you a little bit extra on top. So theoretically, if you hold that bond for the entire term, then you are gonna end up with more money than you started with, because they're gonna pay you back your full principal and they're gonna pay you interest at regular intervals. Now that's the basic understanding of bonds, but guess what? The people who initially buy the bonds don't actually always wanna keep it for that entire 10 years. So guess what happens? They, if they want that money up front, will sell their bonds. So bonds can also be traded on a secondary market. All right. let's pause again so that I can just tell you that if stocks and bonds are still confusing to you, don't worry. Most people don't understand financial assets the first time they hear about them because it's a hard concept to grasp. This whole time, we're talking about intangible things. These assets that have value, but we can't see or touch them, and this marketplace where you can buy and sell these assets that you can't actually roll up to. You can't go to the mall and buy these assets there. So most of what we're talking about in the financial world with investing is stuff that you have to just imagine almost if you want to understand it. The key takeaway is this: investing is the process of buying assets. Oftentimes, when we're talking about investing, those assets are financial assets, which are intangible. You can't see them, feel them, touch them, use them in the real world. Sometimes, though, those assets are things in the real world, like real estate. Now, as you buy more and more assets and you start to collect them, you add them to what is called your investment portfolio. You can think of this like a hypothetical folder or a box that holds all of your assets, all of your financial assets. Now remember, every single asset that you own has value. That value goes up and down, and altogether, your entire portfolio value goes up and down. Now, if this is starting to make sense even a little bit, and you're ready to get started with investing, then definitely check out my video on 3 ways to get started investing as a beginner with just a few $100s. And if this still doesn't make sense to you, it is okay. Number 1, stick with it. And number 2, don't be shy. Feel free to drop your specific questions in the comments. I am always happy to make videos on the most frequently asked questions because I want to help you. I want to see more people investing. All right, until next time, peace out.